Today's analysis focuses on Bittensor subnet tokens as a potential addition to institutional digital asset portfolios. We'll examine these assets through the lens of venture capital due diligence, infrastructure investment principles, and emerging technology allocation strategies. Our investment committee has been evaluating subnet tokens as part of our broader AI infrastructure thesis. While the asset class presents significant opportunities, it also carries substantial risks that require careful portfolio construction and risk management protocols. This analysis will address key institutional concerns: regulatory compliance, liquidity considerations, custody solutions, and correlation to existing portfolio holdings. We'll also discuss position sizing recommendations and implementation strategies suitable for institutional mandates. The research from Unsupervised Capital, referenced in our supporting materials, provides additional quantitative frameworks that complement our institutional analysis approach. From a portfolio construction perspective, Bitcoin and subnet tokens serve different roles despite both being blockchain-based assets. Bitcoin functions as a digital store of value with gold-like characteristics. It's a portfolio hedge against monetary debasement and systemic financial risk. Subnet tokens, conversely, represent equity-like exposure to AI infrastructure businesses. They're more comparable to investments in cloud computing providers or software-as-a-service companies than to traditional cryptocurrencies. This distinction is crucial for proper portfolio allocation and risk budgeting. The correlation profiles differ significantly. Bitcoin demonstrates negative or low correlation to traditional equity markets during stress periods, making it an effective portfolio diversifier. Subnet tokens likely exhibit higher correlation to technology stocks and growth assets, reducing their diversification benefits. From a treasury management perspective, Bitcoin's predictable monetary policy and established custody solutions make it suitable for corporate treasury allocation. Subnet tokens, with their governance mechanisms and staking requirements, present operational complexity that may not align with conservative treasury policies. The liquidity characteristics also vary substantially. Bitcoin trades across multiple regulated exchanges with deep order books and institutional-grade market makers. Subnet token liquidity is concentrated in fewer venues with wider bid-ask spreads, creating execution risk for larger position sizes. Risk management requires different approaches. Bitcoin's primary risks are regulatory and technological, while subnet tokens face business model risk, competitive displacement, and technical execution risk. The failure modes are distinct and require separate risk budgets within a portfolio framework. Our institutional valuation approach adapts traditional venture capital and infrastructure investment methodologies to the subnet token structure. We employ a three-stage analysis: technical due diligence, market opportunity assessment, and tokenomics evaluation. Technical due diligence examines the subnet's AI capabilities, competitive positioning, and technical roadmap. We evaluate the team's track record, open source contributions, and peer recognition within the AI research community. This parallels our approach to evaluating early-stage AI startups. Market opportunity assessment applies McKinsey-style total addressable market analysis to specific AI verticals. We model adoption curves, pricing power, and competitive dynamics to estimate potential network revenue. This differs from crypto-native valuation methods by focusing on real-world business fundamentals. Tokenomics evaluation examines the relationship between network success and token value accrual. Many subnet tokens suffer from weak value capture mechanisms. The network can succeed without driving meaningful token appreciation. We specifically look for tokens with strong cash flow distribution or governance utility. Our financial modeling incorporates Monte Carlo simulations across multiple scenarios: base case, steady adoption; bull case, rapid market capture; and bear case, competitive displacement. We stress test models against various market conditions and regulatory environments. Due diligence extends to operational considerations: token custody requirements, staking mechanics, governance participation, and tax implications. Institutional investors need clear operational procedures for each subnet token position. We also conduct peer analysis comparing subnet tokens within similar AI verticals. Relative valuation helps identify potentially undervalued opportunities and avoid overpriced assets riding on general market enthusiasm. From an institutional perspective, high APY offerings require careful analysis to distinguish between sustainable yield and unsustainable speculation. Our framework evaluates yield sources, sustainability metrics, and risk-adjusted return profiles. Sustainable yield derives from network revenue distributed to token holders. We conduct cash flow analysis similar to dividend stock evaluation, examining payout ratios, coverage ratios, and growth sustainability. Most subnet tokens currently fail this analysis due to minimal real revenue. Unsustainable yield from token emissions creates dilution risk that often exceeds the nominal yield benefit. Our models incorporate dilution effects, token unlock schedules, and sell pressure from yield farmers. Many high APY subnet tokens deliver negative real returns after accounting for these factors. Risk-adjusted return analysis employs modified Sharpe ratios incorporating cryptocurrency-specific risk factors, regulatory risk, technology risk, and liquidity risk. We benchmark against traditional high-yield investments and other crypto assets to establish appropriate risk premiums. Duration analysis becomes critical for locked staking positions. We model the option value of liquidity using Black-Scholes frameworks adapted for crypto assets. Longer lockup periods require higher expected returns to compensate for liquidity sacrifice. Portfolio-level analysis examines how subnet token yields affect overall portfolio risk and return. High-yield positions often increase portfolio volatility and correlation during stress periods, potentially undermining their value as alternative investments. Our recommendation is to focus on yield quality rather than yield quantity. Sustainable 8 to 12% yields from productive networks often provide better risk-adjusted returns than unsustainable 50% plus yields from speculative tokens. Current market conditions present both opportunities and risks for institutional subnet token allocation. Valuations appear elevated relative to current network fundamentals, but early-stage infrastructure investments often require paying premium prices for future potential. Our analysis suggests the market is pricing in aggressive adoption assumptions across most subnet categories. Base case scenarios for many tokens require 10x, 50x growth in network usage to justify current valuations. This creates significant downside risk if adoption disappoints. However, the institutional opportunity lies in selective allocation to high-quality subnet tokens with sustainable competitive advantages. The infrastructure layer of the AI economy will likely generate substantial value, and early positioning in winning networks could drive significant returns. Regulatory clarity represents both opportunity and risk. Clearer regulations could legitimize the space and attract institutional capital, driving prices higher. Conversely, adverse regulatory developments could severely impact token values and limit institutional participation. Our recommendation is cautious allocation within a broader digital assets portfolio. Subnet tokens should represent 5 to 15% of total crypto allocation, with individual positions limited to 1 to 2% of total portfolio value. This sizing reflects the high-risk, high-potential return nature of the investment. Implementation should focus on dollar cost averaging over 6 to 12 months to mitigate timing risk. We recommend avoiding tokens with unsustainable yield mechanics and focusing on networks with clear paths to revenue generation and token value accrual. Geographic and regulatory diversification across different subnet categories helps mitigate concentration risk. AI infrastructure includes multiple verticals, language models, computer vision, data analysis, each with distinct risk profiles and adoption timelines. For institutions considering subnet token allocation, we recommend a phased implementation approach, beginning with pilot positions in 2 to 3 high conviction opportunities. This allows for operational learning while limiting downside exposure. Custody solutions require careful evaluation. Most institutional custodians don't yet support subnet tokens, requiring specialized providers or self-custody solutions. Operational due diligence on custody providers is essential. Tax implications vary by jurisdiction and token mechanics. Staking rewards may be treated as income, while token appreciation faces capital gains treatment. Professional tax advice is essential for institutional compliance. Portfolio reporting and risk monitoring systems need updates to accommodate subnet token characteristics. Traditional crypto risk models may not capture subnet-specific risks like network performance or governance changes. The unsupervised capital research provides additional quantitative frameworks suitable for institutional analysis. Their approach complements traditional due diligence with crypto-native metrics and valuation models.